To begin with, sir, a good set of numbers that came in. Revenues up nearly 4.8%, and you had a net profit which has doubled on a year-to-year basis. Can you take us through the realization picture during the quarter in Q4?
Yeah, thank you, Sajid, for having me on the show. Yeah, Q4 was more about cost takeouts. Revenues were quite flat. The revenues improved significantly in Q4 compared to Q3. But I think we've been doing a lot of work on cost takeouts both in India and in Europe, and some of that played out. And that's a number. That's a benefit that you see in the numbers for Q4. But overall, the market situation is getting a bit better. In India, the safeguard duties have helped. And in Europe as well, the spreads have improved a bit because the raw material prices have come off, and steel prices are reasonably stable. So we're looking at this trajectory continuing going forward.
Sir, during the year you brought in the Kalinganagar new furnace into play, and if you look at the India volumes, it was around 21 million tons, which is higher by 5%. Do you see further jump in volumes in terms of deliveries coming in FY26?
Yeah, in FY26 we are guiding that the volume will be about 1.5 million tons higher. Kalinganagar itself will be about 2 million tons higher, but we have a blast furnace relining coming up in Jamshedpur, which will take out some of the volumes at an overall level. So that's why our guidance is 1.5 million tons more, basically in India in FY26 over FY25.
And how do you look at the European market, especially the Netherlands market, where you have seen some kind of cost efficiency gains coming in, and also give us a sense of how UK is looking now?
Yeah, so in Europe, you won't see too much of volume growth because we're pretty much peaked on the volumes, maybe a little bit more in Netherlands than you saw this year, because the big jump came in this year compared to last year, where the volumes are significantly higher. Overall, we see the Netherlands numbers continuing to get better because of the transformation actions that we are taking, and there is an improvement in spreads in Europe thanks to some of the quotas imposed by the EU in response to the tariff measures being taken. As far as UK is concerned, we continue to take out costs. We've taken out about 230 million pounds of fixed costs during the last year. We'll take out another 200 million pounds of fixed costs this year. So the markets are not great in UK because UK doesn't have the quotas that Europe has. We're seeing the pressure from the market, but on a cost side, we're taking out a lot. So we're expecting the EBITDA numbers in Netherlands to improve this year compared to last year. And in UK as well, we hope to get into positive EBITDA territory during the year.
Okay, you may not be positive, but in terms of EBITDA, you will be positive in FY26.
Absolutely.
What's happening to the entire revamp which is coming up in the UK? Have you started the work? What kind of investments is going to come in from you?
Yeah, so as we announced last year, it's a 1.25 billion pound project, out of which we're getting a 500 million grant from the UK government. The balance 750 million pounds will be put in by us. So over the last 6 months, we were working on the planning permissions, which we've got. I think by end of June, we will have all the permissions that we seek. We hope to start construction and do the groundbreaking and start construction in July. We've already placed a lot of orders for the equipment supply, and we are on track to get it up and running by FY27.
Sir, how do you look at the entire market as a whole, domestic market and globally? We're seeing a lot of disruption which is coming in with respect to tariff between US, China. Now it's gone for a pause for 90 days. How do you see the entire market dynamics changing? Is it from a pricing point of view and from a volume point of view?
So steel is a global industry. Not only does steel, about 400 million tons of steel go across borders, about 2 billion tons of raw materials for making steel goes across borders. So we are very geopolitically plugged in. Also, all our customers are global industries, automobile, packaging, appliances, so on and so forth, construction, etc. So whatever happens in the world has a big impact on us. So the tariff situation was not very helpful because most of our customers are part of global value chains and uncertainty doesn't help. But now that we are seeing some sort of stabilization on that, settling down of tariffs, signing of bilateral trade deals, I think we expect that the fragility that the market was encountering over the last few months will not be there going forward. So we are positive about it. because tariffs also would have had inflationary pressures, which would have put pressure on interest rates, which doesn't help us again because we are a capital intensive industry. So overall, I see the situation improving in the last maybe 2, 3 weeks than we felt in the first week of April.
There are two trade deals that are in focus. One is the India-UK trade deal, and the other one is UK-US trade deal. How does this benefit you in any way?
Well, for us, India UK does not have much of an impact on steel. The UK US, we sell about 80 to 100,000 tons of steel from the UK to the US. So that had a little bit of doubt about it, but that's gone off with this. It's not yet a formal trade deal. I think it's some sort of an agreement between the UK and the US, and that's beneficial to us. Again, more importantly, bringing down the import duties on automobile exports from UK to US is helpful for us indirectly because we sell to the auto industry in the UK as well. So overall, like I said, lower tariffs is or stability in tariffs is good for our business.
Sir, in FY25, you did a capex of nearly 16,000 crores. Is there a guidance that you have for FY26 and 27?
It will be in that range. It will be about 15,000 crore plus. It will be 15,200, 15,300 crores.
And where are you going to put in that capex in?
80% of that will be in India because we will be completing the Kalinganagar expansion. We have a electric arc furnace coming up in Ludhiana, which should also get ready during the year. And then the other sustenance capex in India, also the investments that you're making in mining, because mining, particularly iron ore mining, continues to grow to feed our growing steel business.
What would be the total capacity once the entire capex is through in India?
In India, will be about 25 million tons with the Kalinganagar expansion included. And then after that, next year, it'll move to 26 million because we'll have the Ludhiana plant up next year. I mean, by the end of this financial year.
In one of the statements, you had mentioned that you're investing nearly $2.5 billion in T Steel as a measure to infuse capital into some of the step-down subsidiaries. Can you give us a detail about where all this investment is going through?
No, I think that was maybe miscommunicated or misrepresented. Basically, what we're doing is onshoring some of the offshore debt that we have.
Okay.
So we're putting in money as equity and bringing back the debt. So there's no increase in leverage because of that. It is just a rebalancing of the way we have our debts, and we want to get more and more debt into India because that's where the cash flows are. It helps us from that point of view.
And so, where is the debt going to be replacing? Which are the companies where you're going to replace some? Is it some of the European operations that you will definitely see some of the debt replacement?
No, not. It's more in the holding. The Tata Steel Holding is a company in Singapore through which we had made a lot of the investments. So we are just basically replacing the debt lying there with equity that we are putting in from here and carrying debt in the Indian balance sheet.
How do you see the debt picture playing out? Because your net debt was somewhere around 82,600 crores at the end of FY25. What is the kind of timeline and trajectory that you have to bring down this?
So even if you look at the last 6 months, end of September, we were at 88,000 crores net debt. So we brought it down to 82,000 crores in the last 6 months, and we'll continue to bring it down during this year. I don't want to give you a specific number, but clearly we are today at a net debt to EBITDA of about 3.2, and we've always said that we want to be close to 2.5 or better. So we want to move towards that. I'm not saying we'll reach that this year, but let's wait and see. We are working towards that.
You had mentioned in various calls that you're looking at a savings of roughly around 11,500 crores, 4,000 crores coming from India, 3,000 from UK, and 4,500 crores coming from Netherlands. Where are we on that? Are we on track to meet that kind of savings which you had articulated?
Yeah, a lot of actions in all geographies are going on. Like I said, we've already taken out 230 million pounds of fixed costs in UK last year. We'll take out another 200 million pounds. So that itself is more than 2,000 crores, right, out of the 3,000 crores. In Netherlands, we announced a 500 million euro transformation plan. So that's where the 4,000 crores is coming from. And we have multiple initiatives to support that. And India also, we have a lot of cost takeouts planned because we continue to drive efficiency and excellence across all our operations. So I think it's big numbers, but we are quite confident we are there.
You had articulated for FY26. Will that happen in FY26 or it may spill over to next financial year as well?
No, I think it's for FY26. I don't want to give up in April or May. I think we have the next 11 months. We will certainly chase those numbers and deliver it.
My final question to you, sir. Your adjusted EBITDA per ton was around 8,121, a marginal decline versus year on year. How do you see the EBITDA per ton, moving from here? Means, do you see prices to remain at the same level, or there is some firmness which will come in?
So if you look at our Q4 numbers itself, the EBITDA per ton is much better. This 8,100 is more reflective of the full year, right? So as the European business moves from negative EBITDA to positive EBITDA, it will no longer be a drag on the India business. If you look at our consolidated numbers, the consolidated EBITDA is lower than the standalone EBITDA, right?
Yeah,
That's
yeah,
because Europe has had negative EBITDA,
yeah.
partially because of UK. Last year, in FY24, it was because of Netherlands and UK. In FY25, it is only because of UK. Hopefully, in FY26, we should have a consolidated positive EBITDA from Europe. And we are looking forward, certainly, to UK also breaking even on its own.
Mr. Narendran, it was a pleasure talking to you today. Thank you very much for joining us on NDTV Profit.
Thank you, Sajid.
Thank you.